The $20 trillion panic. How one war can shake every stock. Early morning in New York. A trader refreshes his screen. Oil jumps. Not a little. 5% in less than 2 minutes. No earnings report. No economic data. Just one headline. Regional conflict escalating. By the time the sun rises in London, $1.8 trillion has already moved across global markets, and by the end of the week, investors around the world will quietly erase nearly $20 trillion in market value, all because of a war that hasn't even officially started yet. This sounds dramatic, but it's happened before, and the system that makes it possible is stranger than most people realize, because global stock markets aren't just reacting to war, they're reacting to the possibility of war, and that difference matters a lot. Every day, trillions of dollars sit inside pension funds, hedge funds, sovereign wealth funds, and retirement accounts. That money is spread across thousands of companies, factories in Germany, tech firms in California, shipping companies in Singapore. These businesses have nothing to do with a geopolitical conflict thousands of miles away. But markets don't price the present, they price the future. And war is the ultimate uncertainty generator. Imagine you're running a large investment fund. Your job is simple in theory: protect capital, grow it if possible. Now, suddenly there's a chance that a major oil route could be blocked, or a key semiconductor region could become unstable, or global shipping insurance could spike overnight. You don't wait for confirmation. You reduce risk, which means selling. And here's where things get interesting, because when large funds start selling, they rarely sell the specific problem, they sell everything. Index funds unload entire baskets of stocks. Algorithmic trading systems detect volatility and accelerate the move. Risk models flash warnings. More selling follows. Within hours, a localized geopolitical event begins spreading through the financial system like electricity through a circuit. Banks tighten lending, commodity prices swing wildly, currencies shift, and stock markets from Tokyo to Frankfurt begin moving in sync. It's less like a rational calculation and more like a global nervous system reacting to pain. History shows this pattern clearly. When Iraq invaded Kuwait in 1990, global markets dropped nearly 16% in weeks. After the attacks of September 11th, U.S. markets erased over $1.4 trillion in 5 trading days. During the early days of the Ukraine war in 2022, more than $10 trillion briefly disappeared from global equities, not because companies suddenly stopped existing, but because uncertainty exploded. Investors hate many things: low growth, high taxes, even recessions. But what they hate most is not knowing what comes next. And war creates the biggest question marks of all: energy supply, trade routes, military escalation, sanctions, cyber attacks. Every scenario forces investors to rethink the future. And when trillions of dollars try to reposition at the same time, markets shake. Most of the time, the world economy survives these shocks. Oil stabilizes, trade adapts, companies adjust, and markets eventually recover. But during the panic phase, the damage feels very real. Retirement funds shrink, governments scramble, and headlines start asking a familiar question: is this the beginning of something bigger? Which raises a strange possibility. In a world where information moves instantly and trillions of dollars can relocate in seconds, a war doesn't actually need to destroy the global economy to shake it. It only needs to convince investors that it might. And that leaves us with a quiet but unsettling thought. In modern financial markets, is the real threat the war itself, or the fear reaction that comes before it?